Professor Fama is the Robert R. McCormick Distinguished Professor of Finance at the University of Chicago Booth School of Business. In 2013, he was awarded the Nobel Prize, jointly with Robert Schiller and Lars Peter Hansen. David Booth is the co-founder, co-CEO, and chairman of Dimensional. David and Gene have been working together for over 40 years, and much of Gene's research serves as the foundation for what we do at Dimensional and for what you do with your clients. In this session, David is going to interview Gene about his personal and academic life and their collaboration over the last 40 years.
Thinking about the simple dividend discount model, and what people have been saying for years, basically that the book-to-market ratio is a noisy measure of expected return because the price in the denominator is affected by the discount rate, which is basically the expected return. But it's also affected by expected cash flows, which is what is being priced. So you've got a variable that's responding to two things. And if you can take account of information about expected cash flows, in principle you should get a better measure of expected return. So that's why we started thinking about expanding the three-factor model to include a profitability and an investment factor, because net cash flow is basically profits minus investment. And it turns out that this group of stocks, small, not just small, but basically micro-cap growth stocks, show up everywhere in lots of different anomalies. Basically, that's the major driving force. So the list of anomalies got shrunk, and the anomaly itself gets shrunk somewhat because the five-factor model explains lots of it, but not all of it. So
who do you think buys those things then?
Somebody's buying them because they're.
Well, they say it's marketing. What's the pitch? I got this tiny company's going nowhere.
I don't know.
Anyway. Well, that's right. You can't. One of the great things about the business
it's a model. It doesn't explain everything.
Yeah, right.
For example, take value and profitability. So suppose you say, I want value stocks that are highly profitable. Okay, good luck. They don't exist. So if you want to take advantage of profitability, basically you have to give up some value. And that's the general nature of the problem of balancing these things. Now, it's worse to do it by buying slices than it is to put it all together and look at it, because at least when you put it all together,
slices, what do you mean?
So you buy a value product, and you buy some momentum product, and you buy a size product or whatever. That is a very suboptimal way to approach this. You don't see the interactions among those things when you do that. You always want to take a total portfolio perspective on it. So we've done lots of work on profitability added to size and value. And although profitability seems to have a big effect on its own, when you add it to size and value, the effect is tiny. And that's difficult, because in order to take advantage of it, you have to give up a lot of value.
Well, you know, when we came out with small cap fund, people said, I understand that dimension. Small is riskier. And
right.
Low price, maybe those stocks are selling
right.
Low relative price because of risk.
Right.
How do you explain profitability?
Okay, you can't explain it in one dimension. You have to say it's part of a multidimensional problem in which I want to think of it coincidentally with thinking of value, because again, if I look at the book-to-market ratio, it's got information about expected returns, but it's also got information about profitability. So if I control for profitability, my information in the book-to-market ratio about expected returns is enhanced. So you can't think of it on its own. You can't say, what's the story for profitability? It's part of a total story that says the price is a function of riskiness, the discount rate, and it's a function of expected cash flows. You have to control for the expected cash flows if you want to get the best information about the discount rate. So that's the way you think about profitability, not why are profitable firms have higher expected returns. That's a one variable perspective, and this is a multiple variable scenario.
And what about this momentum stuff? You know, what do you think about that?
It's been in the data everywhere except Japan. So it's there. How to capitalize on it is a different issue because it dissipates very quickly and the turnover is very high. So the way academics do it, they will sort on returns for like the past year and form deciles based on momentum and then redo it the next month. But in fact, no portfolio will ever be operated that way. So if you start looking at longer holding periods, it's going to mute the effect quite a bit. So
Okay.
it's there. I mean,
Yeah. So
it's in the
dimensional.
extremes, though. You gotta take into account the fact that the gee whiz part of this is in the extremes. Momentum is an extreme phenomenon. It's a phenomenon in the extremes. And very few of the extremes will show up even in the stocks that make it into the value category. So if you want to try to run one of those strategies, that's fine. I think the trading costs are, I know the trading costs are going to be way higher than they are for, so if I run a portfolio with monthly recalculation of momentum, that portfolio is going to turn over a couple 100% a year. What we know from our value portfolios is that the turnover is like, what, 20% a year?
Yeah.
Right. So there's much more persistence in the value category than there is in the momentum. Active management is a zero-sum game before costs. That's arithmetic. That's not a hypothesis.
Are we active or passive then?
You're passive.
Okay.
You don't like that, but it's true.
No, I don't care. Actually, I'm going to like it again.
Okay.
Go ahead.
Okay. But I define passive as you're not trying to pick stocks, you're not trying to time the market.
Yeah, I've even thought about, see, in the old days when we first started index funds, you know, there were some pretty bizarre.
Indexing is different. I don't define passive equals indexing.
No, okay, well,
Indexing,
that's what.
indexing means you're trying to nail an index. That's stupid. Because it costs to do that. You're demanding immediacy when you do that. So if I'm running a small stock fund and I'm demanding immediacy, I'm going to pay the spread. That's not a good approach. So passive, I mean in a much less restricted way that says you're not trying to pick stocks, but you will be careful about how you trade them. You're not targeting any particular index in some blind way. And you don't try to time the market, because the evidence on your ability to time the market is, if anything, weaker than your evidence on your ability to pick stocks.
Yeah, no, it's, I'm glad you brought it up, because it's, occasionally our clients ask, are you active or passive? And I say yes. Something about half
You tend to equate indexing with passive.
Yeah, it's the nomenclature's gotten really
Right.
kind of fuzzy.
Alright, thank you guys for watching. I hope you learned something new today on investing. If you enjoyed the video, make sure to destroy the like button, and as usual, if I missed anything, drop it down in the comment section below. And if you're new here, please subscribe for more videos and real investing advice. Check out some of my other videos from my investing playlist, where I talk about the most important topics and teach you what to do. So, until next time, stay the course and keep investing on a regular basis.